The New Zealand economy has long been seen as resilient. However, a government report out today on business innovation suggested more development is needed to boost the country's economic performance. I'm joined down the line by Bryon Gould, former UK politician and New Zealand economist, to discuss the country's expansion and inflation. Mr Gould, thank you for joining me. Firstly, the gross domestic product in New Zealand expanded 1.1% in the first quarter of 2012. What were the reasons behind this?
Well, New Zealand has had a fairly fortunate experience during this recent period of following the global financial crisis. And some of the reasons why we've done tolerably well are that, first of all, our major export markets, Australia and China, have both been pretty buoyant parts of the global economy. So the demand for New Zealand goods has stayed fairly high in those markets. And then secondly, I think the price of primary products of the sorts of commodities that New Zealand produces, and I'm thinking particularly of dairy products, meat, wool, horticultural products and so on, that price has gone quite well for New Zealand, and particularly dairy products have reached quite high levels, in fact record levels at some points. They've fallen back a bit over the last 6 or 8 months, but have started to turn up again. But that's been a major factor. And then thirdly, I think, although the Christchurch earthquake, which was a terrible disaster, and the recovery from that is taking a long time, nevertheless the stimulus to the construction industry is likely to boost gross domestic product growth figures quite considerably. So those are the main factors, I think, that have produced a tolerably good, but not exceptionally good, GDP performance. It remains the case, however, that the economy is growing quite slowly, and we're only just getting back to the levels of 2007.
This is all very positive information, and yet today a survey was released on behalf of the Reserve Bank of New Zealand showing inflation expectations in New Zealand fell to their lowest in 3 years in the third quarter. But opinion is really split between analysts on what will happen. What do you see for inflation for the rest of 2012?
Well, I think the low inflation rate and the outlook for a low inflation rate both reflect the fairly sluggish performance of the domestic economy. So, in principle, it's expected here, I think, that inflation will remain a non-problem, as it were, for the next year or so. The only qualification that we have to make, I think, is that the housing market, which has traditionally been a very significant part of the New Zealand economy, the market in housing has started to heat up quite considerably, particularly in Auckland, the country's largest city. And there's been quite a substantial increase in average house prices in Auckland, and that is likely, I think, in the end to spill over into the rest of New Zealand. So there is a degree of asset inflation starting to build, and that may be something that will attract the attention of the Reserve Bank as they start to look at interest rates, say 9, 12 months from now.
Are the strengths of the country offset at all by the New Zealand's domestic savings rate?
Well, of course, historically, and by that I mean over the past, 20, 25 years or so, New Zealand's had a very poor domestic savings rate, partly because, as I say, the economy has not performed wonderfully well, and New Zealanders tend to have focused more on consumption rather than exports, and therefore on spending rather than on saving. But with the advent of the global financial crisis and then the recession, with the global recession at any rate that has followed that, there's been quite a slump in consumer confidence in New Zealand. It remains at quite low levels, and people have tended to restrict their spending and to therefore place any cash that they have in paying off debt or putting that money into some of the saving schemes that are now available.
Interest rates in New Zealand are relatively higher than many others around the world. What is the reason for this, and how can the government address it? In your opinion, will the central bank need to use stimulus?
Well, interest rates in New Zealand terms, are actually quite low at 2.5% is what's called the official cash rate, and that's as low as it's been in living memory almost. But that remains relatively high when one looks around the globe. And of course, in most circumstances over the last decade or two, you're quite right. New Zealand interest rates tend to have been right at the high end of the range in international terms. And the reason for that is that I think quite wrongly in many ways, the New Zealand government and Reserve Bank relies heavily on interest rates and on high interest rates, both to control inflation and to fund or help to fund the country's trade deficit. And interest rates are offered to overseas investors who buy short-term bonds at relatively high interest rates. And they're attracted by those high interest rates, of course. Unhappily, the consequence of that is that the value of the New Zealand dollar is forced up and tends to price New Zealand goods out of international markets, including the domestic market, with the result that the trade deficit doesn't get any better and we have to go on borrowing and therefore offering high interest rates. So it's something of a vicious circle.
Thank you, Mr. Gould, for those interesting insights. Make sure you click back tomorrow as I'll be bringing you the latest news from Portugal's economy. Until then, take care.